Good day, everyone. Thank you for joining us. My name is Anda. Today, I'll take you through some of our thoughts on Shoprite following their first half results for FY22. Starting off with our executive summary, over the couple of months, we've seen a structural shift in the retail sector that has favored private brands as well as e-commerce. This trend has especially benefited Shoprite as they had a first mover advantage in terms of e-commerce. We expect this trend to continue to be the case, though may be less pronounced as the other retailers fight for their market share. Also last year, the company announced its intention to acquire Masscash, which is a division of Massmart. While this business makes sense for Shoprite in terms of servicing a lower LSM, it's been loss-making since 2017. As such, as the company, which is Shoprite, incorporates this division, we expect to see a margin pressure. On a forward PE basis, Shoprite is trading at a 15% premium to its historical average, but at a 5.1% discount to its peers. The company continues to lag its peers in terms of its dividend yield. The company's dividend yield is at 2.8% versus a peer average of 3.3%. When we value the company, we found a potential upside of 0.1% to our estimated weighted intrinsic value of 236 rands. As such, we have a hold recommendation on the counter. Now, moving on to the actual results. So the company had a like-for-like sales of 9.3% as a group. When we look at South Africa, it had like-for-like sales of 10.7%. Of this, volume was 8.1%, with price inflation at 2.6% higher compared to the previous period. In terms of gross margin, the margin remained flat at 24.1%. Trading margin expanded by 0.3 percentage points to 6%. Overall, the diluted HEPS increased by 25.2%. Now, in terms of how the market reacted to these solid results, they had a muted reaction, and I think this is because we had trading updates leading to the release of the actual results. So the share price on the day was only up 0.8%, while the index, which is the benchmark, was down 0.6%. If we look at how the company has performed since our recommendation in Jan last year, it's outperformed the JSE index, so it's been up 68.6%, while the JSE has been up 25%. On an earnings basis, EPS estimates for FY22 have been on an upward trend, and this is on the back of the market expecting the company to continue to see market share gains across all segments. Now, moving on to our valuation. So we'll see here that we have done the intrinsic valuation, and then we've also split it in terms of its scenarios. That is your base, bear, as well as bull case. In terms of what we've assumed for our base case scenario, we've applied a 5-year historical average of EV/EBITDA multiple of 10 times. This assumes market share gains will continue across all LSMs. And then for our bull case scenario, we apply an average of 10.9 times. This is assuming, again, the continued market share gain across all LSMs, but also we assume that the company is going to be able to pass its input cost inflation onto consumers. Thus, we're expecting a margin expansion. For our bear case scenario, then we apply a multiple of 8.4 times. Here we assume that the acquisition of Massmart will be completed in FY22, and this would then lead to margin contraction, given that this business is a turnaround. So when we weight these up, we then arrive to weighted fair value of 236 rands 50 cents. Thus, we have a hold position on the counter. Should you wish to place a trade with us, please take note of the following personnel, and kindly note that our full report on the company is available on MyBase. Before we end off, I would like to also draw your attention to the following disclaimer. Thank you.